Welcome to the Shikama Live Show with your host Shikama. This video is, of course, targeted towards my Patreon supporters. Thank you very much. Here are 5 ways to lose money with a dividend reinvestment plan. I consider this video important because if you're going to be following me in my dividend reinvestment plan portfolio that I plan to make to ultimately generate $50,000 of income per month in a portfolio, this should be information that you should know. Investing in dividend-paying stocks is a smart way to generate passive income, and signing up for a dividend reinvestment plan, DRIP, is a strategic way to build wealth. With a DRIP, investors have the option of rolling dividends over towards the purchase of additional shares of a company's stock or receiving them as a cash distribution. Aside from taking some of the stress out of building a portfolio of stocks, DRIPs can also be more cost-effective than purchasing shares through a brokerage. There are, however, some potential costly pitfalls investors need to steer clear of. Number 1. Choosing the wrong payment option. Dividend reinvestment plans are designed to allow for the automatic reinvestment of dividends, but that may not be the default setting for a DRIP when you first enroll. Depending on the company or brokerage that's offering the plan, dividends may be transferred to a money market account instead of until a different election is made. While that would make the money more accessible in the short term and offer a greater degree of insulation against risk, it would also mean missing out on some higher yields as long as those dividends aren't being reinvested. Number 2. Overlooking plan fees. One of the primary advantages of investing through a DRIP is the fact that many companies offer them with few upfront or transactional fees. That doesn't mean, however, that you should assume a dividend reinvestment plan is fee-free. This is particularly true if you're enrolling in a DRIP through a brokerage. In that scenario, you may be expected to pay a setup fee, administrative fees, or commissions each time your dividends are used to purchase additional shares or fractional shares of stock. If the fees are too high, they can easily cancel out any dividend income the stocks are generating. Number 3. Missing out on the stock purchase discounts. In addition to allowing investors to reinvest their dividends, many DRIPs also offer the option for purchasing additional stocks shares at a discount. The discount varies from one plan to the next, but often ranges from 1% to 10% off the current market price. When the plans also charge no commission fees, the result is a much lower cost basis. An investor who routinely purchases additional stock through a DRIP without taking advantage of this savings opportunity can easily cost themselves hundreds or even thousands of dollars per year unnecessarily. Number 4. Lacking consistency. Dividend investing is not a strenuous pursuit for the most part, but doing it successfully means being willing to go the distance. One of the easiest ways to short-circuit your portfolio growth is to waffle in your dividend reinvestment approach. Jumping back and forth between reinvestment and cash payouts, for instance, or switching from one DRIP to another makes it more difficult to harness the power of compound interest over time, draining money away from the portfolio in the process. And number 5, forgetting about taxes. While dividends are reinvested, they're still a form of taxable income and must be reported on your taxes as such each year. If you sell any of your shares for profit during the year, you're also required to pay short-term or long-term capital gains tax, depending on how long you've owned the shares. Failing to plan ahead for the additional tax liability created by dividend income can lead to a major headache at tax time if you end up owing more than you anticipated. In conclusion, dividend reinvestment plans are a good choice for investors who want a straightforward way to invest in established companies with having to be actively involved in trading. Best suited for those who prefer a buy and hold approach. These plans take some of the hassle out of investing, but they aren't 100% foolproof. Before investing in a DRIP, it's important to be clear on what the plan costs, how dividends are reinvested, and what additional benefits, if any, are available to be sure you're getting your money's worth. Thank you for watching the Shkama Live Show.